Hi, everyone. I'm Allison with List Self Storage. For those of you who don't know, List is a platform for buying and selling self-storage properties. So today I'm talking with Mark Degner and Seth, and we're discussing kind of just what's in store for self-storage. So can you guys just introduce yourselves? Mark, can you get started?
Sure. I am president and CEO of Safeguard Self-Storage. Safeguard's got 80 stores, about half in New York, and we're also in Miami, Chicago, Tampa, New Orleans, and Philadelphia markets. In my career, I've split my time about 50% of the time with real estate operating companies and the other 50% of the time in private equity. So I have a view that's a little bit more capital markets oriented, a little less operations oriented.
Seth, what about you? Tell us about your background.
I'm the founder and now I guess retired CEO of Red Dot Storage, where I served in the CEO role, I think, for 7 years. And then after leaving Red Dot, I created Storage Exchange, which is a data-focused self-storage brokerage platform, as well as Storeline Management, which is a management platform. And I currently own and operate 9 properties down in Texas under the Storeline banner.
Perfect. Well, thank you guys so much for joining us today and lending your expertise. We'll just jump right in. So we've seen the competitive acquisition environment primarily created by the institutional capital investing in storage. What new challenges do you recommend investors look out for in the coming year?
Who do you want to take that?
Oh, sorry, one job, right? Okay, Seth, why don't you go first?
Yes, so I think, obviously we're seeing really compressed cap rates, and I think that trend is gonna continue for a little bit. But we're also seeing rising interest rates, and so we're heading into a rising rate environment. So I think really what that means is there's a particular emphasis on the underwriting, the discipline of just really clean, solid underwriting. But it's going to put a lot of emphasis also, I think, on the operations side of the business. Really, it's kind of building the investment thesis and then ultimately having the operating platform to go execute on that. I mean, it's a competitive market, margins are tight, and you have to have, I think, the operating platform to go out and execute on whatever is being assumed in the investor underwriting.
Mark, what are your thoughts?
Yeah, I think, echoing a lot of what Seth said, I think, look, we have a lot of great fundamentals in the sector, and I always get a little scared. I saw a bank post something yesterday saying, look, they'd be disappointed if anybody didn't hit 7 to 9% revenue growth this year, and that's on top of a record growth last year. And part of me says, hey, when things are always good in real estate, they always start going the other direction. In private equity, we talked about vintage year, and vintage year is essentially saying, you know what, everybody can claim they're better than everybody, but quite frankly, when you buy low, you always do better than when you buy high. And we're sort of buying high. We got all-time fundamentals. So I do think there's a lot of pressure on NOI. All the expense categories are going up and pretty significantly. We all talk about property taxes a lot, but I think we've seen insurance increase about 20%, for the last 3 years running. There's going to be pressure on advertising once the occupancy starts dropping a little bit. All the other categories, people, maintenance, all are involving people that are, it's being covered by inflation, right? Everything's, it costs more for gas. It's costs more to hire people. It's, everything's sort of boiling up here. And I think we need sort of a perfect storm to keep that underwriting going. And I think we will. We'll see it for the first half of the year. I think we'll see all those, leases that were done in the later parts of last year, kick in and drive NOI. But the second half of the year, you got a high bar. You had all this, all the leasing that was done on the later half of the year is now your base, and now you got pressured expenses. I do think your NOI is going to start, dropping down over the next year.
Sorry, Mark, I definitely want to hear from you on this next question, just given that you have so many properties in New York. Just throughout, COVID, and we've recreated our everyday lives with delivered goods being kind of our new go-to. So do you consider valet storage to be a threat or a complement to traditional storage as we're moving forward?
We see it as a complement. We have not seen them as a threat at all. I mean, the reality is we don't hear customers saying they're leaving to do this. I look at the business very differently. That, I think it's really a moving and storage business when it's all said and done, and they've sort of morphed that, as opposed to sort of, I would compare them more to your traditional moving people than I would self-storage. And when you think of from an operations standpoint, most stores, we have two people, right? Manager, assistant manager. They've got trucks, they've got, insurance issues, liability issues, people carrying refrigerators downstairs, dropping things getting stolen. There's just so much more liability, and really a different model here than what we have. And incrementally, we don't feel like we've lost, tenants to these people. So I think it's one of those things that it comes up in so many conversations, and yet we just don't see it ourselves.
Yeah, Seth, what do you think?
I agree with that. I mean, I think from my read on it, I think that it's a service that's going to be geared more towards users in urban markets, focused probably on smaller items that are being stored. And I think about our customer base at Storeline, and these people are primarily storing furniture and family heirlooms and, I don't know, cars or stuff like that. And that's not stuff that I think that's easily serviced in a valet model. And the second thing is the number one factor that that seems to affect their decision to rent is proximity to their home. And so typically it's that 15-minute drive time. And to me, that translates into convenience. And so if a customer wants, basically a customer's gonna rent a unit and they want to be able to access their stuff at their discretion, at their convenience. And so I think, if they're renting a unit and they can get in there within 15 minutes whenever they want based on their schedule, that is convenient. If they have to schedule, a delivery time and there's sort of a time window or drop-off window, I don't view that as being as convenient. So I don't view it as a threat. And I think that there appears to be an opportunity within that service, within the right markets. But in terms of as a threat to the storage industry or traditional storage, I just don't see it that way.
Yeah, I completely identify with that. Even before COVID, I had a pretty small bubble, and it's just gotten even tighter now. So the restaurants that are really close by, the grocery store, everything just got a little smaller. So yeah, sure. That makes sense. Just getting much lazier. That's great. So we've been talking actually about the risk of oversupply for quite some time in storage. And now developers face the increased construction costs and other challenges, but we're still seeing the successful completion of a lot of projects. So what's the right formula for this? And Seth, your turn.
Sure. Well, storage is a business obviously driven by necessity. There's necessity-driven demand. That's what supports storage. And so, the labor market's really challenging. Prices are going up for materials. Projects are, getting pretty thin, and some are getting delayed, postponed, even canceled. Ultimately, sort of similar to my comments regarding, the acquisition market, it's really going to come down to market fundamentals. And I think in this type of environment that we're in, it's going to put, an additional emphasis on the need to really do that diligence and really getting down to a granular level. Simple, supply demand analysis doesn't cut it. I think people really need to drill down, understand, what are the specific demand drivers? How do you quantify those? And ultimately, how do those translate into driving revenue in any given project? And, because, as I originally said, because storage is a necessity-driven demand product and service, eventually, customers are going to have to conform to whatever the market pricing is, to meet their needs. So I guess my point is, I think, finding the good projects, good markets, and ultimately, really proper underwriting and analysis will determine whether or not a deal makes sense or a project makes sense. But it's that discipline to market fundamentals. And then, I think that more endeavor is really going to be key.
Yeah, Mark, what are your thoughts?
Yeah, and I echo a lot of what Seth says, and it's definitely getting more difficult to build, and the costs and really the lead times, quite frankly, things like steel and roofing materials, you might be 9 months, 12 months out right now. And, I think you're going to see some projects sit vacant, partly constructed for a while people that sort of messed up on their logistics. I think one of the conundrums about storage development is, we're sort of an anomaly. We build all our own facilities and hold them, but most of the builders are not long-term owners. They tend to be much more merchant developers, and ironically, your largest owners, your public companies, generally are not builders. So it's a very unusual business in that, other product types in real estate, the biggest owners typically are the builders as well, and it creates a little bit of a conflict of interest that people that are coming in for a very short run profit are not maybe doing all the work that Seth mentioned. Not looking for the best sites, the best visibility on major roads. They may tuck it into an area where they can get the cheapest land. It's a little bit off center, but right now there's a profit. Cap rates are low. People want storage. There's plenty of capital that have flowed into the sector that bail everybody out. And I think long term, I think it creates issues because you're going to have some not so perfect properties in markets that are always going to be renting at a lower rate because they need to lure people to their sites. So I think that's one of the hazards we have going forward is that the formula still works. If you're selling things in mid-3 cap rates right now, people might be underwriting to say a 6 or 7. They're probably really getting a 4 or 5, but that still gives them a spread to make money. And until that stops, that's going to be very viable for these merchant developers.
Yeah, absolutely. A little bit of a loaded question. Any markets to watch? Mark, go ahead.
I don't think there's any secrets anymore out there that, there's enough people interested in storage that they are canvassing every market. So I think, it's more difficult to build on the West Coast, so I think and it's very expensive, right? I've heard people say, the cost just to, attempt to get entitlements can be over $1 million a site on the West Coast. So you got to believe those are the areas where there are opportunities, but at the same time, there's a lot of costs involved in making that happen, and it takes a lot of time. But in sort of the southern markets or easy to develop markets, I don't think there's a lot of stuff that's hidden at this point. That there's a lot of people out there looking, and they're pretty good, and they found it.
Yeah, Seth, what do you think?
My background is more acquisitions than development. I guess, which is maybe worth noting. But I've always liked sort of the non-coastal, non-primary markets, the secondary, tertiary markets. I always think have had some appeal, especially if you can find markets with attractive fundamentals, sound and diversified local economy, population growth, good household income levels. So, are you looking for names? Are you looking for specific markets to throw out?
You don't have to tell us all your secrets. No, not at all.
I need to put a couple. New York and LA aren't on my list. I think it's just the cost to get in, whether it's acquisition or development, is brutal, and the competitive, the operating environment is just hyper competitive, and so I think that's really tough. I like places like, in my neck of the woods, say Fort Collins, Colorado, or Madison, Wisconsin, markets like that, a little smaller, slightly less institutional, but where I think there's really strong fundamentals, and I think there's a compelling thesis there.
Absolutely. So any thoughts on what's ahead before we close out, Seth?
I think obviously, the past year or two have been just phenomenal for anyone in the business. And I think, 2022 looks like it'll be another great year. The market appears to be changing some, and it'll be interesting to see how that plays out. Kind of looks like we're going in a slightly different cycle. But overall, again, kind of the necessity-driven demand for this business is very real. The investor demand is really unprecedented right now. And so I think, overall, I think the fundamentals are strong, they're intact. And, everyone always likes to talk about the biggest threat to storage is more storage. And, it looks like overall, I think partially relates to some things we were just talking about in terms of supply chain, labor, material costs, stuff like that. The development pipeline right now appears to be, it's not overheated, I don't think, and it may be in some specific markets, but holistically, I don't think it's overheated. So, I think the next year, 2, 3 look good. And I think that, people either trying to get into the business or already in the business will continue to benefit from having exposure to storage. Unfortunately, my crystal ball doesn't go much beyond 2024 or 25, so I can't make any long-term predictions. But
it's reasonable.
Yeah, but I continue to be quite bullish on self-storage for sure.
Mark, what about you?
Yeah, I think similar. I think the next the capital flows I think will stay in storage. In the short to intermediate term. Probably the biggest factor being that capital will look at it and say, hey, if we do have an inflationary environment that starts getting high inflation, they'll say, hey, storage is one of the quickest products where you can change your rates, right? The easiest is hotels. You can do it tomorrow. You can raise your rates and you're there. But storage kind of comes in right behind that you're kind of on this month-to-month basis. And let's just say you could probably start raising people every 3 or 4 months if you wanted to, if in a high inflationary environment. Apartments are a year, industrials 3 to 5, and office often 5 to 10. So, people are going to like storage for that reason. Having said that, the capital flowed to this sector because they liked, what was happening. At what point do we not become the darlings, right? That people, there's no secret to why people came to storage, right? They didn't want to be in office, which is the largest sector in terms of dollars, because COVID created a demand question mark. Are we going to have it? What's it going to look like? What changes are out there? Retail, you wouldn't touch with a 10-foot pole because that was being destroyed. So basically people flowed to apartments, industrial, and storage, right? And so at what point do people switch back and say, hey, I want to be in office, I want to be in hotels, I want to be in retail, and some of that capital leaks out of self-storage. And I don't see that happening immediately, but I think you will see it at some point. The relative value of going to office, retail, hotels, et cetera, is going to look better than storage. It's had some good years behind it. We'll probably have some supply issues coming on more in that 2025, standpoint. And I think everybody's going to relook at it at that point.
Yeah, absolutely. Well, you guys, thank you so much. I really appreciate your time. Thanks everyone for joining. If you have any questions, shoot me an email at Alison, ALISON, @listselfstorage.com,